Hey everyone, welcome back to Corporate Decoder. Today we're diving into Sentinel Holdings' latest quarterly report. Let's just say their numbers might need a bit of a security detail themselves because it seems like a lot of value is being lost. And we're going to break down the report and see just how well Sentinel is holding it together. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and hit that like button. We also have a Discord community linked in the description below where you can chat with other finance sleuths. This is Sentinel Holdings' report for the first 3 months of 2025, so we're looking at January, February and March. It's called a 10Q, which is the form companies use to tell investors how they did financially during the quarter. First, a quick ID check. This is Sentinel Holdings, formerly known as James Maritime Holdings. They're based out of Sandy, Utah. They changed their name to better reflect their current business activities. Okay, as of mid-May 2025, they had about 9.4 million shares of common stock outstanding, which basically means that's how many pieces the company is divided into for ownership. Now for the numbers, let's head straight to the most important report in the document. Okay, first things first, looking at the balance sheet. What they own, their assets are about $627,000, and what they owe, their liabilities, are way up at about $5.5 million. What that means is that they owe much more than they own, not a good sign for how a company is being run. They do have about $100,000 in property and equipment, and about $238,000 related to an operating lease, which we'll dig into a bit later. Checking the other side, under liabilities, accounts payable is also very high, clocking in at about $4 million. They only have about $35,000 in current convertible notes payable. What that means is that they owe those people stocks and bonds that convert into ownership but aren't there yet. Sentinel Holdings identifies as a smaller, non-accelerated filler. This basically means they're not a huge company and get a bit more leeway in their reporting. The stockholders' deficit is almost $5 million negative. It means quite simply that they are in deep trouble. This negative balance reflects years of losses. Now onto the income statement, which will be even more insightful than the balance sheet. In the first 3 months of 2025, they brought in about $846,000 in sales. Now, let's check the prior year for comparison. For the same period last year, 2024, it was almost $2 million, so they made about half as much this year. That's a huge drop. Gross profit, which is how much money they have after paying for the products and services that they sold, was only around $35,000. A year prior, it was $670,000. Not good. This is before accounting for the general costs of running a business, which we will check soon. Their interest expense, which is the cost of borrowing money, was over $122,000. You don't need to be Warren Buffett to figure out that that is a lot for a business making $35,000 after cost of sales. Last year, however, their interest expense was more at about $208,000 for the same period, so at least that's a little bit better. However, to be completely fair, their numbers last year benefited from a one-time forgiveness of a PPP loan or pandemic relief of over $1 million. Bottom line, they lost over $600,000 this quarter. Ouch. Last year, same time, they made over $1.3 million. That's a swing of almost $2 million, and it's heading in the wrong direction. Loss per share came out to a loss of 7 cents per share versus a profit of 15 cents per share a year prior. Now we are off to check the changes in stockholder deficit. Looking at the start of the year 2024, the total deficit attributable to the company was already in the negative at around $4 million. And after accounting for the quarterly loss, in just 3 months, it ballooned to almost $4.07, $7 million negative. The direction is definitely not ideal. Moving along to the cash flow statement, which can offer more insights. They used almost $200,000 in operations. The prior year, they had almost $900,000. They used about $8,500 in purchases. They repaid about $30,000 in notes payable and almost $500,000 in loans, meaning cash going out the door. The prior year, that number was significantly smaller, clocking in at $405,000, plus an additional $200K of loan repayments. To offset those numbers, they took out an additional $471,000 in loans. This means the company is struggling to maintain cash. During the quarter, they spent about $5,400 in interest payments. Now, let's pivot to more qualitative assessments and commentary. First of all, the company used to be James Maritime Holdings, but now they are Sentinel Holdings. They focus on security services via USS. Gladiator Solutions used to sell protective equipment, but operations have largely ceased. Essentially, they provide physical security and hope to relaunch body armor sales one day after their brand's litigation is resolved. Their liquidity situation, as they call it, is not good. They admit they need to raise more money immediately to keep things running. If they can't, they might have to slow down, cut back, or even stop operations. And their financial statements include a big red flag warning, substantial doubt about the company's ability to continue as a going concern, meaning the company can disappear soon. The part of the company that isn't Sentinel Holdings is represented by a non-controlling interest. To put it simply, it accounts for about 87% of Gladiator Solutions. That number is constantly fluctuating depending on the earnings and losses of each quarter. The report claims they operate as one reportable segment, meaning their CEO looks at the business as a whole rather than breaking it down. However, the report fails to mention the expense requirements separately. They mentioned all the typical estimates related to financial reporting, nothing too special. Of course, they talk about risks because all companies have them. Those are normal. However, they mention they might be dependent on a limited number of customers. One customer A accounts for almost a whopping 40% of all receivables. This exposes Sentinel to risk if that customer doesn't pay up or suddenly takes their business elsewhere. Customer A accounts for 36% of their sales for the last 3 months and nearly 30% for the year. This is too much of a reliance for a single person and they need to diversify. What about assets? Management is expected to make sure their valuables are still worth what they say they are. For example, if the business is failing, those assets might not be worth as much. The company states they did not expect the decline in Gladiator sales and will continue to use that to defend any future losses. I am skeptical, however. Because of all their debt obligations, Sentinel is required to keep track of how much more they will owe based on debt discounts and penalties. This means they have to keep track of what would happen if they defaulted on their debt. Revenue is recognized when or as the company satisfies a performance obligation by transferring a promised service to a customer. However, because they only have one channel to sell, they aren't diversifying well enough. Their revenues are from the single channel personal security services. The others are essentially dead. Finally, they note that they made some changes to how they presented numbers from last year to match this year's report format, but it didn't change the overall financial picture. Checking this section, the company depreciates their assets in a straight line basis. The straight line method of depreciation is a commonly used and very basic method of allocating the cost of an asset equally over its useful life. The SEC requires that each company should split itself into the operations they conduct. This allows us to focus on only one operation and view the performance of that. Sentinel declined to do this. Now, looking at these results more broadly, Sentinel is in need of a security detail themselves. They lost almost half of all revenue. Why? Their customer base is super concentrated. If this customer base does not make a repeat purchase in the future, Sentinel will lose almost all revenues. As a result, the CEO will need to work overtime to turn this ship around. Alright, that's our breakdown of Sentinel Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.